Hi, how are you? I think everything is working. Yeah.
You can maximize the screen.
Oh, okay. Great. Thank you. All right. Let's see. Good morning. Let's see. It's all going. All right. Hello. A fewer number today. Okay. So administrative announcements. Can you hear me in the back? We're good. Okay. Administrative announcements. Woke up this morning, my 6-month-old has pink eye, so tomorrow I need to stay home with him, so class is canceled tomorrow. I'm sorry to do this to you, but there is no babysitter and wife is traveling, so no class tomorrow. We will resume the material on tippee liability on Tuesday of next week. And we'll probably need some kind of makeup event. I don't exactly know when, so I'm going to reach out to the registrar and see. It just depends on how much material we get through, but maybe in the next couple weeks we'll find a time, maybe for one class. Today, office hours. So we're ending class a little early today. You're more than welcome to come to Data Science Day, where I'll be speaking about informed trading and cybersecurity breaches for 8 minutes. It's a lightning talk. So you're welcome to come and hang out and listen to that if you are otherwise bored. Probably have other things to do. The office hours today will begin when I am back from that around 1:15 or 1:30ish. And we'll go to 3. I have a 3 o'clock committee meeting. So we'll do office hours from 1:15 to 3 or so, and no class tomorrow, just making sure. I'll put out an announcement so everyone knows that, in fact, class is canceled, even if they didn't come today. All right. So this morning, Axios tells us that Trump hates Amazon, not Facebook. Did anyone else see this morning? No? Well, there you go. So Trump hates Amazon, not Facebook. And what's the price of Amazon? I don't know. Let's see. So it hasn't been good for Amazon. Things were looking pretty good. Things were looking pretty reasonable until yesterday afternoon. Let me see if I can blow this up so you can, I can zoom in so everyone can see this. So things are looking kind of bad for Amazon, especially this morning. So there's a big drop from 4 p.m. yesterday. This is Amazon's stock price for those who can't see it or wonder what I'm looking at. So Amazon's stock price was sort of declining yesterday afternoon, but really dropped on the order of, I don't know, what is that, 100 divided by 1,500? Someone do the math. What's the percent? 100 divided by 1,500. 1%? 6%? 6%. All right, there we go, 6%. It fell about 6%. I guess, I don't know if we could even say from the high yesterday of 1574. It was pretty bad. And the story, of course, is that Trump hates Amazon, and that should be enough to destroy, well, yeah, there it is, 6% in market cap. Yeah, it's right in front of us. There we go. So that's bad if you're Amazon. It's good if you bought Amazon put options yesterday, because it turns out that someone did, right around 12 o'clock. So this is a graph of put option, quote, pricing, volume on Amazon. Put option, as you remember, is the right to sell a security at a particular price. This particular put option, you can kind of see this pattern across more than one, but this one is the right to sell Amazon at 1437. You can kind of see that over here. I don't know how visible this is to you. I'll try to, yeah, that kind of messes it up. I'll just read it out. It's 1437. That is 1,437. And you see that's sort of roughly right in the range that was crossed overnight, meaning that if you had, and in fact we're below that as of right now, so if you were to have, so think about how this works, if you were to have bought this put option, would give you the right to sell Amazon stock not at $13.97, but to sell it at $14.30. So you'd make, there we go, $45 a share. It's not, you know, a lot of money per share, but the other thing you can see if you look at the options graph is just how much. So I guess this is 1437 and a half. I'll take out. Sorry, so that one was driven. Sorry, so did I get that wrong? Let me see here. Did it change my date range? Let's look at this one more time. Yeah, no, I had it right. So this is 1437. Now it's just 1437. What's kind of cool if you were buying put options is that how much did that option cost you? Well, the price of the option of those option trades was $3.92. How much is that same option worth now, just less than 12 hours later? Because this trade was executed at 12:25 p.m., so less than 24 hours later, right? So it turns out that same option is worth $37.85. So while Amazon stock did not go down that much, I guess 6% is non-trivial, the price of the put option to sell Amazon stock went up by a factor of 10 times as expensive. So good news if you bought that put option. Maybe, unless you get thrown in jail as a result. So we're going to try to think about whether or not buying a put option on Amazon is in fact insider trading, now that you know something about insider trading law. And we'll think about that as we go through the cases. Okay, so keeping this example in mind, I don't know who did that. Maybe the White House, maybe Kushner, I don't know. Oh, that could be a fun exam question. All right, so here we go. So investors management. So we're going to kind of run through some of these cases. I don't think we're going to get to Yun, but today we'll try to just sort of set out the contours of insider trading law. So just to make sure everyone's can talk as if they went to law school, and when people say things like the classical theory, you don't go, which Bach, Beethoven? You say, no, the classical theory of insider trading liability versus the misappropriation theory. So let's just kind of recount how the classical and misappropriation theory arose. Remember in Katie Roberts, the sort of story in Katie Roberts was a director who was sort of sitting in on the meeting, heard about the dividend, ran off and told his broker friend who placed the trades. So the theory that the court articulated in Katie Roberts, that the SEC articulated in Katie Roberts, was a theory of sort of breach of fiduciary duty. That is, the director had a duty to not to sort of act vis-a-vis the rest of the shareholders of the firm in a way that that sort of upheld these notions of fairness and fair dealing and everything that goes into fiduciary duties. And of course, we also learned that not every fiduciary duty violation, potential fiduciary duty violation, is a basis for 10b-5 liability. But it turns out that breaches of fiduciary duty that involve trading are in fact the sort of sine qua non of 10b-5 under the Cady-Roberts sort of view. And then comes along Investors Management Company, and there's a lot of facts here, but basically, just for the sake of time, since we got a lot of material in a short amount of time, it's not clear how many have actually read this, so I'll just give you the basic key points. So you want to just remember there is in fact this company Douglas that is in touch with Merrill Lynch, and in fact it turns out that Douglas is going to have poor earnings in 1966, contrary to the market's expectations. And it turns out that Merrill Lynch is telling all kinds of people. There's a Merrill Lynch salesman who calls these vice presidents for this fund and says Douglas is going to have disappointing earnings. And then there's, in fact, this company, Van Strum & Town, whose president is sitting at a luncheon, and he hears that Douglas is going to have no earnings. And the question, so what happens in investors management is that the SEC takes the view that all of the above, including people who just receive information from Merrill Lynch in this case, or even the poor president who's like sitting at a luncheon finding out about Douglas's earnings, all of the above is the kind of information that is prohibited under 10b-5 to serve as the basis of trading. And so investors management really reflects a kind of extreme construction of not just insider trading prohibitions, but the whole notion of what it means to commit fraud in the purchase or sale of a security. And what you see here on page 730 or 248, I guess, of this partial reader I've given you, is that the conclusion here that the SEC reaches is that the information in question has to be material and non-public, and all what we need to establish is that the tippee, we'll talk about tipping liability in its modern form, but just sort of as the law was, I guess, in the 1960s, 71, the tippee needed to know or have reason to know that the information was non-public and that it had been obtained improperly by selective revelation or otherwise. And so the story, the kind of classical story that the SEC, not the classical theory, but the sort of historical story that the SEC wanted to tell was that if you know that you got information in a way that was sort of not kosher, you're sitting at a luncheon and you're hearing something, or you have a conversation with an analyst, or somehow you know or have reason to know that the information was non-public and obtained improperly, whatever that means, that's sort of enough. That is fraud in the purchase or sale of a security. Now you can see how that's a very aggressive interpretation of fraud, departs tremendously from the sort of fiduciary duty-based analysis that we saw in Cady-Roberts, animating the sort of story of directors who have fiduciary duties, and the SEC is going so far as to say not only that the information is material, not only that this matters to investors, but on page 249, sort of the middle of the page, the circulation of rumors as to earnings among a limited number of investors present at this luncheon would not constitute the kind of public disclosure that would suffice to place other investors in an equal position in the marketplace. So what the SEC is basically saying is you can even tell like 50 people some news, But if the entire market isn't aware of that news, it's still non-public. So remember, we said yesterday one of the challenges in this area is kind of defining what it means for information to be public. And as Felix pointed out, Felix is not here, as Felix pointed out yesterday, it there's this kind of inherent circularity problem that if information is fully public and sort of in the stock price already, then there's no basis to trade on it. So it's kind of tricky to figure out when information is sufficiently public under the investor's management standard. That's what's going to bother me as an economist, but that's not what bothers the courts in the judicial sort of evolution of insider trading doctrine. Maybe because judges are an economist, maybe who knows, but they're bothered not by the fact that this is a slippery standard, but by the fact that it doesn't seem to have anything to do with fraud. Okay? So this is the sort of story of insider trading law, is this evolution from these kind of broad, sweeping statements of equality and access to information that maybe have some economic sort of content towards a very legalistic almost lens, right? That there's a wrong that needs to be corrected, and that is what eventually takes us to Chiavella. I don't know, Chiarella? How do you say it? All right, questions on this. Is this clear, sort of where the SEC wants to take the law? Everyone sees this? So in between, in the readings, we talk a little bit about Adler. I'm not going to spend that much time. The key point in Adler is whether or not you have, whether you need to show that there's actual use of material non-public information. And you can imagine that this is, so you can fit this into the narrative of how the SEC is trying to broaden and broaden and broaden the reach of insider trading law by including not only cases where you traded, because causally you had that information, but also cases where an executive just trades while in possession, mere possession, of material non-public information. And this further pushes the scope of insider trading law to more or less prevent executives from trading, again, unless they can somehow establish under these standards that aren't very clear whether or not they could establish that the information had already made its way into the stock price. But if mere possession is sufficient, then you really, or knowing possession, then you really have to imagine that basically as an insider, you really just can't trade. Now, what I want us to be thinking about, and again, even though the law in this area has kind of not followed economic theory very well, but there's still kind of important connections, right? So you want to ask yourself, if we care about price accuracy and protecting investors, what is the effect of prohibiting insiders from ever trading on information, this is forever trading while in possession of information, right? So one concern with, and this is what kind of comes out in Adler, but more so in the Rule 10b-5-1 evolution, which you can read about in the notes following, is that, look, if we don't allow insiders to buy or sell, particularly sell, for reasons that we think may not have to do with information, we're really going to be reducing the amount of liquidity in the market for that stock. And that's because insiders often have large shares, large amounts of shares, and they might want to, liquidate those shares for reasons that has nothing to do with secret information, right? And so going back to our investor protection story, which, remember that from the first half of the class, kind of worry that if we remember when I explained how the bid-ask spread, or the prices at which markets can transact, are always kind of a combination of informational and non-informational sort of guesses, right? So we said that if you could perfectly separate the market, so you could say if you're selling, it must be because you have bad information. And if you're buying, it must be because you have good information. Then in fact, it's going to be very costly to buy or sell. Because nobody will want to take the other side of a bet against an informed player. So we said, remember, just to refresh, that informed trading, where we're seeing wider bid-ask spreads, okay, reduces liquidity, meaning it's harder to transact. Why? Because there's information in the trading itself. So in this way, we talked about noise traders, or sort of uninformed trading, you could say. Uninformed trading actually boosts liquidity, right? Because it's your ability to reason from the lack of information that makes you more willing to transact at that expected value. Remember we talked about sort of the $10 and 9 and 11, which is traumatic memories now, but just think back, 9 and 11, and we said, look, you're only willing to transact at that midpoint to the extent that you are facing a trader who's uninformed. Because if you're facing an informed trader, you're always going to want to transact at either the higher or the lower price. That's because they have information. So you'll make the inference that if the world is good, then they're probably buying because they know that, and so you would be crazy to sell to them for something like 10. You would always want that price to be higher that you're going to sell to them at, so 11 in this example. All right? So the fact that you have trading for reasons that have nothing to do with information is actually really good for markets from a liquidity standpoint. Does everyone see that? Remember that conversation we had early in the semester. So now if you think about the use versus possession test that we read about in Adler, well, if an insider could establish that they're trading, even though they possessed non-public information, that their trading was in fact not informational in nature, right? Not based on that information, not buying when news is positive and selling when news is negative, but buying and selling for reasons that have nothing to do with the news. If the insider could establish that, that would in fact enhance liquidity, right? That would in fact make it easier for just others and uninformed investors and just the entire market to buy and sell in the stock of the firm. So Adler kind of takes this view that says, well, we're going to assume that we're going to view the possession of information as a presumption that you used it in your trading. That's the holding of Adler. The presumption is rebuttable. However, don't worry about rebutting it most of the time, because Rule 10b5-1 basically comes in to solve this problem. And it basically says, look, if you set up a trading plan in advance so that on each week you're going to sell a particular amount of securities, or buy, I guess you could do too, the fact that you've sort of pre-committed to that plan in advance and that it's going to just execute and you have no discretionary control over your 10b5-1 trades, that should in fact tell the market that these trades are not based on material non-public information, that while you possess material non-public information as an insider, these trades are not motivated by it. So, in fact, the selling pursuant to a 10b5-1 plan should not be viewed as a negative bet on the firm, but just simply a liquidation of your securities to, in fact, get cash. Okay? So, formally, we'd say that, the rule states that if the trade resulted from a pre-existing plan, contract, or instruction that was made in good faith, then in fact the trader did not use the information. So legally, we'll say that the use test is not satisfied, that requirement is not met in the case of a 10b5-1 plan. All right, so is this clear to everyone? So here again, we've got a little pushback I'm sort of hinting at. We've got a little pushback against this broadening of insider trading liability that we see the SEC trying to do in investors management, and a recognition that there are times when, in fact, we want to allow some sort of trading by insiders. In this case, when we are pretty sure that there isn't information motivating the trade. And now we get to Chiarella. All right? So now let's talk about this case. And now I'm going to see who read the case and who wants participation points. 30% of the grade, that's a lot. Yeah.
Okay, so Chiarella worked at
What's your name?
Conrad.
Conrad. Great. Yeah.
He worked at a print shop that was able to see documents
Yeah.
from law firms about pending transactions, tender offers, and the merger.
Yeah.
That information he decoded, deciphered which company it was coded, it was sort of hidden what firm was involved, but he was able to kind of figure out who was involved and bought shares in the targets, and then as soon as the transactions were publicly announced, sold them, and then
Great. Perfect. Now, Conrad, what's the problem with getting Mr. Chiarella on the basis of the classical theory? What's the basic problem with pinning him down under 10b-5 for this trading on material non-public information?
he doesn't have the same type of confidential fiduciary-like relationship
With?
with the person that he's transacting.
Close. Close. Okay, does he have a relationship with, who does he definitely have a duty of confidentiality with? Acquirer. Right, exactly. Who does he not have a duty of confidentiality then? Just in the transaction, there's acquirer and target, right. Just to be clear, it's the target who, this is the problem, right? Because under the classical theory, your duty, you're put in prison for trading on the basis of information in violation of a fiduciary duty to the entity and to its shareholders. And you're right, just to be clear, though, it's the target. That's the key point here. Those shareholders are the ones to whom you're supposed to have a fiduciary duty that was violated. That's the story. And that's not working here, right? It's not working. And that's a big problem. Why, Conrad, was it a problem in this case in particular? There's something about the procedural posture. Court talks a lot about this.
This is a criminal
Yeah.
conviction, so there's some discussion about what was charged to the jury.
Great. Exactly. So Conrad reminds us that the jury instruction was under, literally the classical theory was charged to the jury. So the jury was told, see if we can find the exact language of the charge. The district court's charge permitted the jury to convict the petitioner if it found that he willfully failed to inform sellers of target company securities that he knew that of a forthcoming takeover bid that would make their shares more valuable. Okay, that's not exactly as helpful. Somewhere in here there's a discussion later on of the exact language. Maybe someone will find it. Of the, oh, here we go. Yeah. We need it. So this is on 1118 of the Supreme Court Reporter. We need not decide whether this theory has merit. The theory we're going to come back to, the misappropriation theory, for it was not submitted to the jury. The jury was told in the language of Rule 10b-5 that it could convict the petitioner if it concluded that he either employed a device, scheme, or artifice to defraud or engaged in an act, practice, or course of business, Accordingly, the jury was instructed that the petitioner employed a scheme to defraud if he did not disclose material non-public information in connection with the purchases of the stock. In other words, the fraud, the fiduciary duty violation, if you will, in its this derivative sense, the deception, okay, was, ran to those target company shareholders. The problem is that there was, in fact, no such duty for Mr. Chiarella with respect to these shareholders. So, in fact, in the following page, 1119, the court points out the jury was not instructed on the nature or elements of a duty owed by petitioner to anyone else other than the sellers. Now this is really you can see this as kind of a sort of judicial, sort of drawing a line in the sand and saying, look, we're not going to let, at least one view of this is we're not going to let the SEC start to read into every time you have material non-public information some breach of a duty you owe to your seller, because the consequence of that is that, in fact, you have no asymmetric information in trading. Like at the end of the day, if I'm breaching a duty I owe to a seller when I know something more than them, I will never be able to trade. Never. If I know something more than them. And in fact, it's sort of easy to see why that's a crazy outcome, because if I'm buying, it must be because I think the firm is worth more than it is, at least if this is an informed buy. So if I think the firm is worth more than the current price, if I were to tell my sort of counterparty why that's the case, and they were to reach the same conclusion, they wouldn't sell it to me at the current price, right? So there's something kind of wrong, and this is what's motivating the sort of line in the sand that's being drawn in Chiarella. Okay, so most of the debate turns on whether or not there's another ground for getting Mr. Chiarella. So Conrad, so the little discussion of the sort of misappropriation theory, tell us what is exactly the court looking for. So we see this in, in Brennan's dissent. We see this in, Stevens' dissent. We see this in the U.S. government's position. So what do they want the court to hold?
They want the court to basically say that it's enough if somebody gets material and non-public information with some difference in how they're
Yeah.
improper or unlawful or way that violates some kind of other duty, regardless of
Yeah. So not quite regardless to whom, but definitely some other duty, right? So what's bothering the government, the SEC, and what's bothering, pretty sure it's Stevens, is that there is, in fact, a breach of a duty of confidentiality here, right? Everyone sees that. The breach of the duty of confidentiality is between Mr. Chiarella and the acquirer. So the question is, can you teleport, right, the target of the offense? You ever do this in crim law? Like, I, meant to, batter person A, but this doctrine of transferred intent, right? So, even though I meant to, slug him, I hit someone else, and so we can transfer. But it's kind of like that. It's like, well, you broke a duty to the acquirer, but you didn't trade in the acquirer's shares. So we got to kind of somehow teleport the target of your breach of fiduciary duty to a different company's shares. That's the sort of analytical problem. And it's helpful to just pause and think about this for a minute, because it's hard to understand, a lot of people think trading on material non-public information is illegal. Well, you know now that that's not right. It's trading on material non-public information in particular settings that tend to involve, breaches of duties of confidentiality to various parties. But the case law in this sort of evolves in a very idiosyncratic sort of twist and turn way. And this is really the starting point of that, right? So when we get to Salmon and we get to some of these tippy cases where, where the notion of whether friends are actually conferring benefits on each other, this gets really, really esoteric. And it all begins with the problem here in Chiarella, that you don't have a clear breach of fiduciary duty theory that works when you're not breaching the fiduciary duty owed to your counterparty. Now, this is a big deal, guys, right? Fundamentally, the theory of insider trading liability is about breaching a duty you owe to your counterparty. So it's getting replaced, well, it's not in Chiarella, but the concern is that it will get replaced with some vague, amorphous duty that somehow could apply to every person. This is, Conrad, the problem. Problem is, it's really hard to find a limiting principle. To whom does that duty not extend? All right, is this clear? I want you to see the problem. Sam, do you have a question? No. See the problem that we have in Chiarella. Is this clear to everyone? Any questions on this? Everyone sees this. Okay, easy stuff. All right, so what happens next? Well, O'Hagan comes along, and we're going to cover Dirks tomorrow, not tomorrow, Tuesday. We'll talk about tipper-tippee liability. But O'Hagan comes along and really tees up sort of the perfect test case to see if the Supreme Court is willing to take that next step. Remember in Chiarella, just to close the loop so everyone remembers that in Chiarella, the jury instruction was on the classical theory. Therefore, because this was a criminal case, all the court could do was just reverse the conviction, holding the jury instruction as erroneous, and that's it. There was no occasion, the court makes explicit, to consider any other theory on which Mr. Chiarella could be held liable. That occasion came around in O'Hagan. So who wants extra points? And yes, let me make sure I check you. Allison? Gotcha. What happened in O'Hagan?
Which is representing Grand Met in its potential tender offer for the shares of Pillsbury.
Do you know what happened to Dorsey? Did Dorsey get bought? Is Dorsey like...
It still exists.
It still exists.
I'm from Minnesota. So.
You're from Minnesota. Great. So, oh, perfect. So Dorsey's still around.
Yeah.
Dorsey's brand wasn't affected by this?
No.
No, okay. Oh, good. Did they like kick him out quickly or something? Okay. All right, keep going. All right, go ahead. Yeah?
And so O'Hagan wasn't actually, I think, working on this tender offer, but he heard about it and bought Pillsbury shares in advance of the tender. And then sold them after the offer went through for a bunch of money.
Yep. Shares and options.
Yes.
Right? Yeah. Kind of like this picture. You can make a lot of money trading options. You can lose a lot of money trading options. A lot. He made a lot of money. How much did he make? It's like over $4 million. All right. So, SEC charges him. And what is the, sort of give us the sort of statement of the misappropriation theory, sort of the textbook statement of why he should be, in fact, thrown in prison.
So on 1191, they explain the misappropriation theory as misappropriating confidential information for securities trading purposes in breach of a duty owed to the source of the information. And it was kind of premised on the deception of the source, so the fact that he didn't have permission from the law firm and from Grand Met.
Yeah. Yeah. Okay, now, I don't think in the little squib that's reproduced here. So I read the whole thing this morning, and Thomas has this great dissent. So just after class, if you want to read, it's just really fun. And he starts throwing out all these, like, nutty, sort of crazy points, but they're actually really interesting. So he says, like, okay, so could Mr. O'Hagan, like, what exactly could Mr. O'Hagan have done, right? So Mr. O'Hagan, suppose Mr. O'Hagan knows about this merger and wants to write a book about the merger, okay? And, like, the book is going to come out before the merger. I don't think he used this exact example. He had some others, but this is, like, the idea. So the book is, like, going to come out before the merger or at the time of the merger, and he's going to make a lot of money writing this book. Is that a violation of Rule 10b-5? Oh, what do you think? Is it a violation of Rule 10b-5? What do you think? I mean, remember, we need in connection with the purchase or sale of a security. So clearly not. So he says, look, you know, imagine that, he pushes the point a little bit further. He says, imagine that Mr. O'Hagan went out and took money and then bought securities with the money that he made from the deal. like before the deal was public. Or he sold the book and he took the book profits and he bought security. Would that be misappropriation in connection with the purchase or sale of the security? It starts to get a little tricky, Thomas argues, because basically, if you think about what this misappropriation theory is saying, it's saying anytime I use information that I wasn't, like in a way that I guess wasn't entitled, we're going to assume the default is you can't trade. I mean, I think in this example, everyone had agreed to confidentiality. So you agree to confidentiality, and I breach that confidentiality, and I go out and I buy securities with it. For some reason, that's not enough to hold me liable under Rule 10b-5, even though I misappropriated information and used it to purchase or sell a security, used it to generate cash that I then used to purchase or sell a security. And the oral argument, the government's response was, well, you know, the moment you converted the information to cash, the misappropriation, the conversion was complete at that moment, and so these are going to sort of separate the subsequent trade from the conversion. So this is like embezzlement or conversion so as to trade. And that is what takes it out of an ordinary sort of prohibition, or even we could say just civil contractual violation of a confidentiality agreement, and transforms it into prison time securities fraud. And again, you didn't read this, so I don't expect you to. I'm just sort of giving you some background here. The majority doesn't really, I think, have a good answer, other than kind of pointing out that, look, most of the time, ordinarily, when you go out and expropriate information and buy and sell securities, you're actually buying and selling on the basis of that information, like most of the time. And most of the time is kind of enough. And so there's something a little weird here if you think about the logic of the argument, because it's not a prohibition on misappropriation. Let's make that clear. It's not that you're being put in jail for misappropriating information that you received at the law firm. It's that you're defrauding a counterparty because you misappropriated information from someone else. And that is a very contorted idea, right? It's a very sort of, you got to really like get inside the court's head. And of course, we read that there is, in fact, a sort of policy-ish rationale on 1193. All right. So what is the court saying here on 1193? The court is basically saying that, well, look, informational disparity is inevitable in the securities markets, but investors likely would hesitate to venture their capital in a market where trading based on misappropriated non-public information is unchecked by law. And herein lies the sort of economic argument. An investor's informational disadvantage vis-a-vis a misappropriator with material non-public information stems from contrivance, not luck. It is a disadvantage that cannot be overcome with research or skill. Now, Allison, do you find that convincing?
I think it could go back to the discussion we had yesterday of we don't know what investors are expecting or not.
Exactly. Good. So Allison points out that we don't know what investors are expecting. So it could be premised on an incorrect assumption. So it could sweep in, that sort of an analysis could sweep in cases where investors assume they're facing an informed buyer or seller and adjust the price they're willing to pay accordingly. In this way, you might say it's an over-inclusive rule because it captures too many situations. Allison, is there a way that it's an under-inclusive rule? I mean, think about that sentence, right? Like, you almost read that as if all other cases of informational disparities are driven by luck. I mean, that's kind of what rhetorically, I mean, yes, formally they're not saying that, but kind of hinting that in this case, it's a disadvantage driven by contrivance, right? It cannot be overcome with research or skill. I mean, are there other cases where that's the case? What do you think?
Well, I think we've talked about informational disparity in other cases, such as the doctor who reads the cancer abstracts.
Exactly. Is that luck? Bless you. Is that no, right? So you think about it, right? There's a lot of other cases of trading on the basis of sophisticated understanding. How about like putting your server next to the SEC server, like these hedge funds do in Secaucus? They have these fiber optic cables that go like right into the exchanges, and they literally can take the same news you can see, but they see it like 50 microseconds before you, and therefore, in the 50 microsecond gap, no amount of research or skill that you would put in could overcome their informational advantage. Yet that is legal. Okay? So we see this as both over-inclusive in that it doesn't always, that it catches more cases than the ones the court has in mind, including cases where prices have already adjusted to reflect the possibility of informed trading. And it's under-inclusive because, in fact, a lot of informed trading is not based on luck. Okay, so that's really the issue with the misappropriation theory, is that it is based not on any kind of economic rationale, but rather based on a sense that it's just wrong to let people steal information and profit off of stolen information. That there's this deception that's inherent. Now, think for one, about whether or not that makes sense. As I said, you can read the Thomas dissent. It's kind of interesting because he says, look, that is also way under-inclusive, that rationale, because you could write the book and sell on it, or you could do all kinds of things with the information, and weak nexus to securities fraud, securities trading might not be enough, probably isn't enough to sweep you into 10b-5. But even putting that critique aside, think about many other settings where sort of there is an exploitation of your informational advantage, and the question in this analysis is really whether or not that amounts to theft or deception. So even just looking at this graph, okay, so if you were to have found out that, say you're in the Trump White House, and you hear that Trump hates Amazon, okay, like or you're the reporter. That's a little harder. But, you find this out yesterday, and you buy a lot of put options. Is there a misappropriation? So, you should have enough information right now, if I pose the hypothetical on an exam, that it's not a tipping case, so let's say it's just the policymaker themselves, he or she, buys Amazon put options yesterday. Insider trading, yes or no? Who wants to take a stab at it? Yeah, go for it, Andrew.
So we already know it's definitely not in the world of classical theory, so it has to be through misappropriation.
Yep.
And then, if you compare to Hagen, Hagen probably has some type of law firm, and then also a law firm to have met. So there might not be that same chain of agency
Ah,
between policymaker and president.
good.
So probably there wouldn't be those violations.
Yeah, good. What do you think?
Yeah, I think also Trump probably wants that information to go public.
Good.
So
Right. Right. Exactly. So he wants information to go public. Maybe he wanted it to go public this morning. Okay, these are good. These are good answers. Okay, dig deeper a little bit. Think about investor protection. So, if you are a buyer of, if you're, holding Amazon stock and you're transacting, is it a good idea that the options market, so, keep in mind this picture, that basically these trades were happening right around here, and it's possible that the volume in the options market caused this decline right here, right? Or at least contributed to it. I mean, the big question you got to think about, and I hope this example kind of makes concrete some of what we've been talking about here. The big question you want to think about is how we should view the speed at which this decline occurs. So in the absence of the options trading, this would probably look sort of more flat up until the Axios article. So the drop would be more vertical. And the question is it a good idea for that to look less vertical? Another way to think about the implication of extending the misappropriation doctrine is that it benefits some and hurts others. There's always a winners and losers sort of distribution, right? So if you are an Amazon shareholder, do you benefit by having transitory mispricing? So for a period of time, that stock stays higher, potentially, because you didn't have this trade in the options market. Notice how much options prices moved yesterday from 12.25 to 3.52. The option itself, you probably can't see that, but the option itself, the put option went from $5 to $17 before the announcement this morning, before the Axios article. By the way, think about another question you might raise in an exam. Is this information? I mean, the great answer is always sort of challenge everything, right? Like you're just creatively sort of every element. So is Trump's opinion about Amazon, like you didn't bring this up in the conversation a second ago, but in all these cases that involve insider trading, it's like things that about the company. But I pushed you on this in the practice exam, and here it is in the news again. It sort of like just keeps coming up all the time. Maybe I should write a paper on this. So insider trading on kind of information outside the company that could be relevant to the company's value, but that could have never plausibly originated from any confidential conversation or breach of duty of confidentiality within the company. Now, you might say the M&A transaction, the sort of hostile takeover or tender offer, is probably most analogous to this. One fact we haven't talked as much about is that hedge funds who acquire blocks of shares on the order of like 4.99% before they announce are freely permitted. So for those who don't know, the Section 13 of the 34 Act requires block holders, those who have accumulated more than 5% of a company's shares, to disclose the acquisition of their block. Now, that means that if you're a hedge fund, you can hang out at 4.99. Right? You can buy shares without disclosing your existence until you reach 4.99%. You can thus effectively trade on the knowledge of your anticipated public action. In fact, not only can you trade on that, you can tell all your friends, now is the time to buy because I haven't announced my 5% stake. So you can go out and buy. So I call up Sam. Hey, Sam, go buy this company now. It's going to be worth at least 5% more the moment I cross my 5% threshold. Why is that? Well, there's always an announcement pop if, in fact, a hedge fund discloses that they've acquired 5%, because that usually means they're going to effectuate some kind of positive corporate change, depending on who you talk to. That's one story. Or it could be that they're going to get the company sold in an M&A deal, and there's an expected deal premium. So you can tell your friends, as a hedge fund, go buy the company now, while I have yet to disclose my 5% block. And it turns out that that's perfectly fine. So is there, you might say, well, formally there isn't a breach of the duty of confidentiality, but suppose there was a rogue hedge fund employee who did just that. Even then, it's not clear that there would be a violation under O'Hagan, because it's not clear that the intent you have as a hedge fund investor to acquire more than 5% is information about the firm. It's a far cry from the kind of O'Hagan style, there's a takeover coming, which is like a fact, or there's a tender offer about to be made, or, right? This is like, I might do it, I might not. I said you can go back to the hypo I gave you to think about sort of Trump's intent in that example to put tariffs on companies. You can think about it here, like what is the meaning of Trump hates Amazon? He hates someone new every day, right? And so is that the kind of information that gets swept in under O'Hagan? Moreover, you might say, if the chances of Trump, of that turning into something that affects the value of Amazon are pretty small, then all this is just very costly speculating. Someone wants to place a bet, and the price of that bet has gone up, and that happens in Las Vegas all the time. But it's not clear that investor protection would be advanced. It's not clear that people are better off when we paternalistically prevent them from taking Las Vegas-style bets. So bet all you want. In fact, you could go even further and say it is the presence of motivated economic players like these who will drive the market in an equilibrium sense, like in the sense of over time, as people learn and update and they get better and better, drive the market towards discerning which Trump emotions are real and which aren't. And that it's actually the ability to make money on trades like these that helps market participants distinguish going forward what matters and what doesn't. You could even say that, in fact, it is the mere reaction of the stock price itself that has accomplished what Trump wanted. And thus, the probability that he'll actually do anything to harm Amazon is very low. Okay, so in other words, it's not trivial, right, whether or not this kind of trading, as distinguished from cases where the event that's going to affect the firm is already set in motion, it's some kind of real economic event, like our CEO had a heart attack or something, right? Or, there's an M&A deal has been inked, or we just hired some famous person, we just got some customer. Those are cases where none of that story I just told you makes sense. It's going to happen one way or the other. All right? So make sure you see this. Yes, Magdalena. Yep. Yep, more than 70%. That's right. Mm-hmm. Yep. Right. Could amount to, I'm sorry? It could amount to, well, I didn't hear you. To fluctuation, yeah. Yeah. Yep. Right. Good. Good. So Magdalena points out that in today's world, prices can move for reasons, large institutional investors can buy or sell for reasons that have to do very little with the sort of classic, with the traditional misappropriation story, and that the volatility that's being introduced to the market here doesn't necessarily square well with O'Hagan's sort of conception of how prices are going to move. In fact, one way to put a point on that is to think, the assumption in O'Hagan is that Mr. O'Hagan knew what direction the stock was going to move. And in an M&A transaction, that's usually pretty clear. There's a deal price, and so if it's less than the deal price, it's going to go there with zero uncertainty, right? That's just sort of definitional assuming the deal is going to happen. So the problem is that a lot of insider trading occurs on corporate events that are far less certain, and so it's not clear at all that misappropriation of the substantive information that you've been given will translate into accurate guesses, right? Into accurate price guesses, price inferences, which way the price is going to move, or even the magnitude of those guesses may not be clear. So the question, and I think this is a good place to wrap up for today, the question is, how suited is the misappropriation doctrine for today's insider trading, right? And we've talked about cybersecurity. We've talked now about about political emotions. And, there's a whole set of sort of 21st century insider trading settings that are not easily captured by the lawyer, let's go back further, by Katie Roberts, the director calling his friend, or the lawyer in O'Hagan running out the door, the order to buy the call options. That today, insider trading is a much trickier animal. We have 2 minutes left. Let me just tell you about another setting, and this is another paper I've written, which basically looks, I think I mentioned this earlier, at hedge fund activism. And we see that when hedge fund activists are on the board of directors of companies, there is an increase in information leakage. And information leakage looks like this. It looks like a non-vertical drop. It looks like a hill that's not a cliff, right? Because it means that at 2 o'clock yesterday, 1:30, 2 o'clock yesterday, people were sort of hearing something is not good for Amazon. And that continued and continued, and so this information leaked out. So in this paper, what we find is that when hedge fund activists are appointed to the boards of companies, when they have directors appointed to corporate boards in response to settlement agreements that are reached with the activists, it turns out that there's a pretty sharp increase in information leakage like this. And one question, and this is kind of a cool way that corporate and securities law interact, is whether or not that's a bad thing, because Vice Chancellor Laster of Delaware wrote a paper in 2013 arguing that when you have minority shareholders, block holders like activists, the board has a duty to share information with them, and that there's a duty to bring in the minority into the decision-making process, because for that reason these directors were appointed. They should be faithful to their constituency. So the question is it even possible to design an insider trading prohibition that excludes trading on this sort of information while at the same time encouraging information sharing between a company and its large block holders? And in the case where these block holders aren't your passive institutional investors, like the Vanguards or the State Streets, but actually hedge funds like, I won't name names, but hedge funds out there who are looking to get major returns, it might be really hard in practice to separate increased information leakage from the other benefits and consequences of hedge fund activism. And at the end of the day, if you think hedge fund activism is beneficial, maybe you're willing to tolerate some information leakage. That's a question. It's a big question. It's a hard question, and it's one that we haven't seen insider trading law really adapt to. On Tuesday, we'll talk about tipping, which is this kind of extension to reach third parties who receive information, but it just gets more and more kind of nuanced and sort of twisted. At the end of the day, this is kind of the state of affairs. We have the classical and the misappropriation theory. Have a great weekend. I'm very sorry, again, class is canceled tomorrow. I got to take care of my son. So see you next week.
Say I'm a doctor at a hospital and a CEO comes in with a heart attack.
Yeah.
Could I trade on that information?
Good question. Could you under the misappropriation theory?
Right.
I don't know. What do you think?
So if I was, say,
I have to walk out for this
someone
event.
who
Yes.
was in confidence with the doctor and like it's medical information that can't be shared, then they wouldn't be able to trade on that.
So like HIPAA could be a basis
Right.
for...
But the Or say,
I'm sorry?
yeah,
Yeah.
if there's a regulatory reason why I can't.
Yeah. I'm so sorry. I have to speak at? Thank you. I almost left the seating chart and my drink here. Yeah. Exactly. So think about, so if you're sitting in the emergency room and you see the doctor and you see the CEO rushed in, harder case.